Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, May the 26th, 2026. Okay, so let's have a look and see what's going on in the markets. Quite a lot of optimism, basically just on this idea that there is sort of some kind of messy deal being worked out between the US and Iran, some kind of compromise. We know that the US did sort of some surgical strikes on a couple of Iranian ships, which apparently were laying down mines. The Americans say that was self-defense. It's not a breach of the ceasefire, et cetera, et cetera. So the market essentially is saying that the war premium has peaked. At least that's what the equity market is saying. So really the big question here is, has the war premium peaked? Probably, but really so that's what the equity market is saying. And you see here the ES equities are new or sort of all-time highs over the last sort of 36 hours. But really what we have to look at also is like the short-term interest rates and the two-year yield, for example. And if we look at just some of the yields here, and I'll get into this in a bit more detail, but if we look at, let's say, something like the two-year yield, they've come down, but not nearly as much as, let's say, the 30-year yield. And so the two-year yield and the short-term interest rates are basically sort of saying, has the energy shock, the inflation shock sort of lasted long enough? Has its impact been structurally strong enough to affect, central banks' sort of reaction function? And this whole idea here is that, you see the curve is flattening. So let's say we look at something like the twos tens, you see this flattening of the curve, or let's say the twos 30s. So what this is telling us is that front-end interest rates are not coming, or yields are not coming down nearly as much as long-term interest rates. And so that's sort of essentially saying that maybe the FOMC, sort of the Federal Reserve, needs to be sort of tighter for longer, and that sort of short-term interest rates remain under pressure, and that basically this sort of rally is a little bit fragile in the sense that inflation tail risk still is present. And what we have to figure out, or what the central banks are trying to figure out, is that, has, sort of this sort of energy shock, the inflation shock, has it moved into expectations? So inflation expectations and pricing behavior. So it's one thing to say, oh, the Strait of Hormuz is going to open soon, energy prices are coming down, everything's going to be fine. But the issue being raised, which was, for example, raised by the ECB's Schnabel the other day, was that maybe actually the energy shock has gone on long enough that pricing behavior and inflation expectations, it's kind of seeped into the sort of the supply chain and pricing mechanisms, and we're going to have sort of much more elevated prices, and that's going to be much more difficult for the central banks to ignore over the sort of the medium term. So, are we getting a relief rally in the equities? Absolutely, yes. But is it clean? Maybe no. It's a bit more fragile. And so really what, we're seeing is maybe sort of geopolitical de-escalation risk is definitely happening. So the risk of more geopolitical escalation is diminishing. But we're also, the bond market is telling us a slightly different sort of stories, especially at the front end of the bonds. It's saying that, the risk of sort of macro transmission of these higher for longer prices is still sort of a possibility. So let's just go through some of the different sort of charts and whatnot. And what I want to show you as well, just in terms of the central banks, what's going on here. For sure, this is a positive sort of development. And what we're seeing here, but just keep it in mind. So, for example, if we're looking at Europe, we're seeing that you can see that the implicit December 26 ECB policy rate, as I say here, so essentially what the market was pricing in. You can see here that, when the war started, this ripped up from, maybe 1.75% as the policy rate. It ripped up to over 2.75. So almost like 100 basis points of tightening. But subsequently, that's given it back a lot over the last 36 or 48 hours. So that's a positive for Europe and for the ECB policymakers. So definitely over in Europe, that the implicit sort of rate of the Euribors and whatnot has come down. So that's going to be sort of a tailwind for European equities. And you can see here that's necessary because if you look at the surprise index, let's say the city surprise index, if you look at the US, let's just look at the divergence here between the effect of the war on the US economy and the European economy. And you can see that in the US, the surprise index, so that's how much the index surprises to the positive side in terms of sort of economic data. So how much the economic data is a positive surprise. You can see in the US, you can see just that's going upwards. So that's great. But if you look at Europe, the same index for Europe, you can see that since the Iran war started, back here, you could see here that that's just gone very, very sort of negative. So essentially, there's been a huge divergence. So, and this was the huge problem for the ECB, that in this sort of a weakening, sort of a growth scenario, but with high inflation, you have kind of like stagflationary kind of situation. The ECB was thinking that they'd have to, well, the market was telling them they'd have to hike 2 or 3 times by the end of this year. But as we just saw, that's been given back a little bit. So that's sort of a positive. But as I say, Schnabel from the ECB was telling us just the other day in a speech that we're not out of the woods yet, and the danger still lurks, and that maybe all of these elevated energy prices has gone into behavior, so inflation expectations, but also pricing. Companies have started to price this in, and companies generally don't give back prices. So that's still an issue. Whereas if we look over in the US, you can see that it's still pretty hawkish. And let's just keep in mind that on Friday, Kevin Walsh, the new Fed chair, was sworn in, of course, by Trump. And Trump said to him, hey, don't look at me, do whatever you think is necessary. So the question is, does that mean that potentially he will hike? I think sort of politically, that's still a very difficult thing to do, maybe just sort of stay on pause for a longer period of time. But you can see here, just if you look back, February the 27th was just before the war happened. You can see here what the market was pricing in. This is for the Fed, this is for the US. You can see it was, over the period going into 2027, it was pricing in, almost sort of 3 cuts. You see 3 cuts here all the way down here. This was going to be the Fed funds rate, the effective Fed funds rate here. But you can see that actually what's happened is that, since the war began, the market is now pricing in even potentially one hike by the end of the year. So definitely much more hawkish. And another graphic which shows that here from Bloomberg, you can see here that, rather than having sort of cuts being priced in, the war has caused going into 2026 and all the period of 2027 here, you can see here that the implied overnight rates are almost up towards 4%. And you can see the number of hikes has gone from sort of actually zero, sort of from cuts, has gone up to almost like 1.5 at the peak, is now for, let's say, what's that, April of 2027, almost 1.5 hikes are being priced in. Now, is that going to happen? I think that's going to be difficult politically, but it's really going to depend on what happens, in the markets, but also the war. And certainly the markets are saying that, hey, the war premium has peaked. So let's just have a look at some of the markets and see what's going on here. So definitely volatility has sort of fallen down. So that's a positive for the equities. We're seeing that in the VIX. We're also seeing, which is also good, that the MOVE index of bond volatility has come down. So that's obviously a positive for equities as well, because equities do not like too much volatility. Now, just getting sort of on the technical position here for the ES, we can see here that, all the moving averages are very, very sort of positive. We've made recent highs just as we speak, giving back a little bit. This is a very strong chart. Really what the market, really what we have to see is a couple of different things today. So what I'm going to be looking at today is, 4 different sort of markets specifically. And really what we're trying to figure out is this a clean relief rally? Is it justified? And what would indicate that's the case? What would indicate a clean relief rally with more to go and sort of, a very strong green light would be the 2-year yield. Let's have a look at the 2-year yield. So you see here the 2-year yield, it peaked on sort of last Friday, and it's come down a little bit. But compare that to the reaction of the 30-year yield. See how the 30-year yield here has come down a lot, whereas the 1-year yield has basically not done too much, and the 2-year yield has come down a little bit. So really what we want to see is the 2-year yield going to come down? Because if the 2-year is going to come down, and that's going to indicate that the market is saying, hey, definitely there's going to be a transmission from a sort of some kind of détente or de-escalation in the Mideast. That's going to translate to a less hawkish Fed rhetoric. So we want to be looking at the 2-year yield. On the other hand, if we continue to get sort of hawkish commentary, keep in mind, for example, Waller from the Fed, his hawkish commentary last Friday, he basically said, this is just after Walsh was sort of sworn in as the new Fed chair. Waller basically said that, hey, if the oil prices remain elevated, that means that inflation expectations and actual realized inflation could go up, and it's going to be difficult, very, very difficult to cut, and certainly a pause, and maybe even the possibility of a hike, and the equities won't like that. So we need to look at really what the 2-year yield is doing, and the short-term interest rates like the SOFR contracts, which for sure those yields have come down, but not nearly as much as the long end. And we also need to see what the Fed members say. There's quite a lot of Fed speak this week, so let's see what they have to say and whether they say, oh, it looks as though there's been de-escalation, that's a positive, et cetera, et cetera. That's going to allow the equity rally to be much stronger. Second thing to be looking out for, of course, is going to be the US dollar. And if we actually look at the US dollar, you can see that, has it weakened a little bit? Yes, it has. It's now here just at the 200-day EMA. But you can see here that it's still relatively strong. It's certainly not where it was, at the beginning of 2026 or even some of these lows from 2025. You can see that it's hanging in there relatively well. And so the question here for the US dollar is that it seems to be saying, okay, the chance of more escalation has diminished. So for sure, the war premium is coming out. But the US dollar is still looking at the Fed and saying, this is not a central bank which is going to be cutting anytime soon. Certainly, it's probably going to be pausing for quite an extended period of time and may even be thinking about some kind of, sort of cautionary sort of a hike at some point later in the year into 2027. So we need to be watching the US dollar. Again, if the US dollar sort of weakens, that will be a sign that the market is more is happier, sort of thinking about sort of a further push, let's say, in the equities. The other thing, of course, to look at is energy. So if we look at energy here, if we look at the front contract here, which you can see, has it come down? Absolutely. And just sort of, by the way, technically here, looking at the CL1 continuous contract, you can see here, if we look at just before the war started, that level where we've come to now is the 38% fib retracement at about 89.80. So pretty key level here. So, the question is, has crude oil come down? Obviously, yes, it has quite a lot. But you can see here that it bounced back a little bit. So really the markets will probably want to see this going down to, into the 84 level, or even all the way back down here to, let's say, the 100-day moving average or something like that. But I don't know that it's going to get back down there because the infrastructure has been damaged. The Strait of Hormuz is still not at all completely open. There's still not a final deal. There's still potentially tolls going to be levied on the Strait of Hormuz. So the oil market is signaling that, okay, for sure, let's take out some of the war premium, but we don't yet have an all clear. And you can see that if you look at the different contracts. So let's look, for example, now at N, which is July. Now, has that come down? Yes, now at about $91 or so, back down to the 50-day moving average where it bounced from. But if we look further out, just look, I want you to be looking here at the rate of change. So if you look now at September, a few months out, has it come down? Yes, but not as much. If you look at December, has it come down? Not nearly as much. So let's look at what sort of the front contract came down. And then let's say, for example, December, you see even a little bit of green there. And if you look out to March of 2027, you can see, yes, it's come down in price, but it's actually sort of pushed up a little bit in the last few hours. So again, if you look at the curve, CL1 minus CL2, which was in a very, 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 very steep sort of backwardation. So a lot of premium paid for immediate delivery that got up to the crazy levels of $15. So has that come down now down to about 287 cents? Yes, it has. And if we look at CL1 compared to December, it's come down. So for sure, the curves are flattening a little bit. So this is a positive development. But what the pricing in December 26 and let's say sort of March 27 is telling me is that the market is not giving a complete all clear in oil. And if you actually go back and look at, let's say, Brent, which of course is a little bit more affected. It's much more the Middle Eastern thing. You can see that it's come down a lot, but still hovering, just under $100 still. It's almost $100. And so that's more than the US benchmark WTI West Texas Intermediate, which is what we often look at. But let's not forget that Brent, which is more of the Middle Eastern and European affecting sort of benchmark, is still hovering around $100. Now, is it down from highs? Obviously, yes. But if you look at Brent and also look at, let's say, December 26 Brent, it's still expensive. My point being that we are a long way from having oil at $70. The reality is that it's gone up as we speak about, $30 compared to where we were pre-war, which is, what's that, about 40% or so. So the point of Schnabel is saying that, hey, maybe oil's coming down, but it's still settling, apparently, it seems, at a much higher price. So definitely we need to be looking at oil today. We need to be looking at the front end yields as well. And we need to be looking at Fed speak, and also I want to just sort of see going looking at the equities. Very important to see, whether this is just going to be, let's say, Nasdaq leading. We're going to have sort of Nasdaq leading, and something like the SOX index, the semiconductors. You can see here the SMH, similar kind of thing for SOX, the semiconductors, and let's say something like the DRAMs. Or whether is this going to be broader? I mean, we want to see more energy. We see, will there, for example, the IGV, the software ETF, will that break the 200-day moving average? That's going to be important. We need to be seeing more breadth. Is the Mag 7s? You see they're lagging a little bit. Are we going to see it broadening out into the Mag 7s, but also into the broader equal weight? So I'm going to be looking at the equal weight here. So far, so good. You can see that in the pre-market, the RSP, which is the equal weight. So it's not just, specific indices or the Mag 7s or semiconductors. You can see that the equal weight is broadening out. And another thing I'm going to be looking at is just the percentage of stocks in the S&P 500 over the 50-day moving average. And again, you can see that that is starting to broaden out. So that to me is going to be important. So again, today looking at the 2-year yield is the front end of the curve, telling us that this inflationary shock is actually really diminishing, and therefore the reaction function of the central banks is going to be sort of less aggressive, less hawkish, and that's going to be reflected in the equities, but not just sort of the leadership equities, let's say the Mag 7s and the semiconductors, but we want to see that in the broader software sector and the broader indices as a whole. So let's be looking at these kind of measurements. And also I want to see if the US dollar remains strong. If the US dollar remains strong against most of the currencies, that's going to be indicating, and let's just look at the US dollar again, that's going to be indicating that the US dollar market is still looking at the Fed and basically saying, hey, we still have a relatively hawkish central bank. So let's see if the US dollar actually, what happens. I'm going to be looking at this 200-day EMA here as the key level. If it breaks down below, then that could give the all clear a little bit more to sort of risk on. And of course, well, let's keep an eye on oil. So that's it, guys. We don't have a huge amount of data today. What we do have is the PCE, which is expected to be hot, but that's really on Thursday. We have a couple of central banks. We'll talk about that later in the week. And we do have quite a few Fed speakers. So let's listen to what the Fed speakers are saying, whether they're sort of pointing over towards the Middle East and saying, definitely looks like a de-escalation. Therefore, that should, reduce in inflation expectations, or whether they actually say, hey, it's way too early. We don't have a definitive agreement in the Middle East. There's still sort of skirmishes. There's still problems. And it's way too early to be thinking about easing or, removing ourselves from the pause. That's what I'll be looking at for today. So that's it, guys. Have a great trading day. I'll be back tomorrow with the macro snapshot from at the macro shop if you want to check that out on YouTube or Twitter. Okay, guys, have a great day, and we'll be back again tomorrow. Thanks so much.